Hello everyone. Let me begin with the backdrop of the last monetary policy review where we had a 50 basis cut in the repo rate. Quite a surprise event, which is why we saw the yields also react quite favorably. The 10-year government security benchmark yield saw a low of almost 7.53% post that event. From then on till the month end, that's in October, the yields have witnessed a little bit of a backup, in fact almost by 12-13 basis points. This was largely in line with what we anticipated. In fact, we did guide markets towards the fact that the month of October is likely to see a huge supply on the primary issuance front, which is the central government loan and the state government loan, totaling to almost a little under a lakh crore. That, coupled with the fact that October month was a short working month because of festive holidays, we saw the yields edge northward and currently are positioned upwards of 7.6%. We clearly believe that these opportunities are good entry points from a fixed income standpoint. It would be very difficult to precisely advise you on the peaking out of the yields because the month of November is also likely to be a short working month because of festive holidays. However, the primary issuances are fewer than the ones we saw in the month of October. The additional icing on the cake is also the FII limits, which have been taken out with great positive optimism, and we believe that for every rise in yields, the captive demand on the domestic front and the foreign investor front would keep an upward lid on the yields going forward. So what are the strategies that one should focus on? We continue to maintain a favorable bias on rates and therefore continue to recommend strategies like the Kotak bond fund, which run a long play on interest rates. We clearly believe that the trajectory of interest rates would continue to be benign, albeit at a slower pace, given the fact that we've seen about 125 basis points of rate cut already in calendar 2015. By March 2016, probably we could see one more rate cut, which would likely take the terminal repo rate to 6.5%. For those who do not mind adding a little bit of credit flavor on the portfolio, we would continue to recommend Kotak Income Opportunities, which is predominantly a play on the high yield segment with a balance and of course with the superior due diligence that we as a fund house do. Last but not the least, Kotak Equity Savings Fund has completed 1 year of existence. This is a marginal equity fund with an equity cap of 25%. In a market like this, where the equity outlook continues to be favorable and the fixed income story continues to maintain favor, we believe that a strategy like this could be recommended to a conservative investor or a first-time equity investor as well. To conclude, we maintain the favorable outlook on interest rates. We believe that there could be some small intermittent disruptions because of which the yields could head northward, but those would clearly be opportune entry points if one has investment outlook upwards of 12 to 36 months. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.